within a couple of weeks. They are available on our HOPP portal website. For those of you who are in the New York City area, if you are trying to access it, let me know so that we can get you in, but it's primarily for those folks who are funded by HOPP. Having said all of that, I would like to welcome and thank Joseph Rabella from MFY Legal Services. He's a staff attorney there, and he presented last year, co-presented last year on the waterfall calculator that he and his colleagues put together. It continues to be a very useful tool, and I'm very pleased that they have improved and enhanced it, and he's here to talk about what it is and how to use it, and thank you again, Joseph.
Okay, thank you, Becky. So yes, today we're going to be talking about FHA loss mitigation with a special focus on how to use the MFY's waterfall calculator to analyze your clients for FHA loss mitigation. So today we're going to be talking about a little bit of background information on FHA, and then the options for FHA loss mitigation, including forbearances and modifications. We'll run through an example using the worksheet, and then I'll take any questions that you might have. So I just want to give a little bit of background on FHA, not too much. FHA is the Federal Housing Administration. It's a department of HUD, and it was created to promote homeownership. It does this by providing mortgage insurance to the secondary market to protect lenders against losses arising from homeowner defaults. And homeowners pay the premiums for this insurance. This insurance is completely self-funding, so they rely on homeowners to cover the costs, and then, of course, FHA has an interest in what loss mitigation is done because they're trying to prevent losses to the program. So the FHA loss mitigation options there are two types of forbearance, informal and formal forbearances, which are both repayment plans, special forbearance, which actually is a forbearance as we typically know it in that it reduces or suspends payments. A loan modification, this is the FHA traditional loan modification, which we'll talk about in some depth later, and then FHA HAMP, which is both a loan modification generally paired with a partial claim, although not always. And don't worry if that didn't make sense to you. We'll be getting into what a partial claim is and how it works. So this is the FHA loss mitigation hierarchy. This is coming from Mortgagee Letter 2013-32, which is where the current FHA loss mitigation structure is contained right now. Unlike HAMP, there's no MPV test. All the loss mitigation is conducted according to this waterfall, which is extremely confusing, which is why we have a 1-hour presentation on it today. Not shown in this big chart that I'm highlighting with my mouse is an additional footnote, which contains two of the options that we'll be talking about, which has caused a lot of confusion. But first, let's start with forbearances. I'm going to go through this quickly since I think most of us don't want to get our clients just forbearances. We want to get modifications and address long-term affordability. But as I said, there's three types. There's an informal forbearance, a formal forbearance, and then special forbearance. Informal forbearance is oral. It's a repayment plan covering 3 months. The house has to be occupied by the borrower and owned by the borrower. And there's no hardship verification. So the borrower doesn't have to prove that they've lost income or had increased expenses. They just have to be able to cover their arrears within 3 months or less. A formal forbearance is a written plan spanning 3 to 6 months. Again, there's no hardship requirement, but the borrower does need to show income sufficient to cure the default within 6 months. And again, this is for borrower-owned and occupied properties. Last, we have the special forbearance, which is an agreement to reduce or suspend payments for borrowers who are unemployed. This is when the loan is at least 3 months past due, and it must allow for at least 12 months of forbearance. After that forbearance, the borrower has to be evaluated for a modification or something to bring the loan current, but at no time can the arrears exceed 12 months. So, for example, a sample of a plan could be that the borrower will pay, let's say, 3/4 of their payment for 12 months. So after 12 months, they've paid 9 months. So they're an additional 3 months past due in addition to the 3 months they were past due at the beginning of the forbearance. So that would be allowable because the arrears never exceed 12 months. What you can't do is say, you know, the borrower is unemployed, so let's not pay at all for 12 months. There has to be enough coming in there so that arrears never exceed 12 months. Okay, so the next thing, loan modifications. So I've divided them into 4 types. There's the FHA loan modification, which is sometimes called the traditional modification or the FHA standard modification. There's then 3 types of FHA HAMP. FHA HAMP, which is just a partial claim, FHA HAMP, which is a standalone modification, and FHA HAMP, which is a modification with a partial claim. In all of these instances, the mortgage has to be at least 12 months old measured from the date of the first payment. So somebody can't get a modification when they've just taken out the loan 6 months ago. 4 full payments have to have been made on the loan, so the borrower has to have paid the loan for at least a little while. The borrower must own and occupy the property. There's a limit. They can have, the borrower can have a modification as often as every 24 months, which is, of course, a big difference for HAMP when you get one for the life of the loan. I'm talking about standard HAMP, not FHA HAMP. And this only counts modifications that have been done in the current regime of FHA HAMP, which basically means since March of 2013. 2012, it has not been 24 months, but that requirement will not apply to them because their modification was before mortgagee 2012-22. If the borrower defaults on a TPP for FHA HAMP modification or a FHA loan modification, they can reapply only with a change of circumstances. And for any modification, there must be a verifiable loss of income or increase in expenses. And all of these require a trial payment plan, just like standard HAMP does. Okay, so now we're just talking about the FHA traditional loan modification, which has a few requirements. The borrower must be in default. Imminent default is not sufficient. The borrower must not be eligible for a repayment plan, so they cannot afford to pay their arrears back within 6 months. The modification must reduce the monthly payment, and the borrower must have surplus income, greater than $300 and 15% of net income. We'll be talking about those terms in a little bit. So the terms of the loan modification for FHA loan modification. Basically, all the arrears are recapitalized, including accrued interest, fees, and costs, but not late fees. Their attorney's fees are allowed to be recapitalized, although there's a mortgagee letter that sets a schedule of attorney's fees. This letter is described in more detail in the written materials that were provided, as is everything on all of these slides. The interest rate is set to a market rate, the market rate being the Freddie Mac primary mortgage market survey plus 0.25%, and then the loan is reamortized over 360 months. Okay. The terms for FHA HAMP eligibility, which is, again, slightly different than the FHA traditional mod. the borrower must be in default or in imminent risk of default. So unlike the FHA traditional loan modification, imminent risk of default is okay. They cannot be eligible for a forbearance or a loan modification. So this means either the loan modification would not reduce their payments enough, or the borrower doesn't have sufficient surplus income. Surplus income is basically the income that the borrower has after all of their expenses, including the mortgage payment. So most people that you see probably will not have surplus income because their mortgage is unaffordable to them with their current expenses, which is why they fell behind. An example of somebody who would be eligible for a loan modification under FHA's rules but also have surplus income would be somebody who had a temporary hardship and then had recovered to where they were or even better than where they were. So, lost a job for a couple of months, fell behind on the mortgage, and then got a new job that paid even more, that sort of thing. And the resulting payment under FHA HAMP must result in a payment with no more than 40% of front-end DTI. So this means that the debt-to-income ratio, the housing costs, including the principal and interest payment on the loan, the property taxes, the homeowner's insurance, and the FHA mortgage insurance must be no more than 40% of the borrower's gross monthly income. Okay, so there's one thing in the mortgagee letter that is clearly in there but is inconsistent with itself, and I've never seen it enforced. So FHA HAMP has a requirement that the mortgagor does not have surplus income that is at least the greater of $300 or 15% of net monthly income. This is in the terms of mortgagee letter 2013-32, which, like I said, is the source of all of FHA's current loss mitigation rules. But it's inconsistent with another part of that same mortgagee letter, which states that if a borrower doesn't qualify for a loan modification, you always look at them for FHA HAMP. I personally have never seen this rule enforced, although as a practical matter, when you're writing a loan modification application, there's no good reason to ever show surplus income on your application unless you want a repayment plan. So it's always a good idea to just sort of avoid that in general and not even come up on this issue. Okay, so now let's talk about the partial claim. The partial claim is something that's completely unique to FHA mortgages. Executes a second mortgage in favor of HUD for the partial claim amount. The partial claim mortgage is interest-free and comes due with the first mortgage or when the borrower no longer owns the property. So from the borrower's point of view, a partial claim is basically principal forbearance. It's principal set aside that interest is not charged on, but that is due at the end of the loan. The only difference is sort of procedurally, the borrower is executing a second mortgage in favor of HUD, which they wouldn't do in a standard modification that involves principal forbearance. A little bit more on the partial claim. The partial claim has a limit of 30% of the unpaid principal balance of the loan at the time of default, and you subtract out any previous partial claims. So if your borrower had received a partial claim back in, let's say 2007, then the amount of that partial claim comes out of the partial claim that they can use now. And it can be used to cover the borrower's arrears, their legal fees, the costs, and any principal deferment as needed. So I'm going to talk a little bit about some recent developments in FHA HAMP. And for people who have not already done some FHA HAMP work, I'm going to urge you to just sort of close your eyes, plug your ears, and think of England for a minute, because this is just going to confuse you more. But for those of you who have done some FHA HAMP work, there have been some new rule changes that I think it's useful to address off the bat before we really go into them. So FHA HAMP was created in 2009 with Mortgagee Letter 2009-23. But it was overhauled completely in 2012, and a series of changes that were actually not effective until 2013. Under 2012-22, the partial claim was always used to reinstate the mortgage, and then the remaining balance of the mortgage was modified. All arrears had to be paid through the partial claim and not capitalized into this remainder of the mortgage. So the result was that borrowers who had more arrears than partial claim amount were just ineligible. So the impact was people got denial letters saying, we're sorry you have excessive arrears. And if you really fought with the servicer, you could generally pay down the difference, but that was not always easy. So in September 2013, Mortgagee Letter 1332 superseded 1222. This fixed an income rule regarding non-wage income, and it contained additional language about capitalization of arrears. The National Consumer Law Center and some other consumer advocates believed that this additional language allowed for that capitalization beyond the partial claim. But the National Servicing Center, which sets the servicing standards for FHA, disagreed and believed that it clarified the earlier rule. And frankly, the language under neither of these mortgagee letters was clear. So to settle this issue, the rulemaking branch of HUD issued an FAQ for both of these letters, stating that capitalization is allowed and then giving preference to capitalization over the partial claim. So they chose the option that nobody thought was right. So that eliminated the reinstate and modify framework that had been in existence. And the result is, like I said, nobody's right. We have now a completely new framework as of February 12, 2014. Compounding issues, the FHA decided that they were going to issue this as an FAQ rather than a rule change. So they, in effect, retroactively changed the rules for loan modifications going back about 11 months. So, before February 12, 2014, the National Servicing Center, a branch of FHA, was requiring that servicers issue excessive arrears denials letters. But then this FAQ was issued saying, that those were improper denials. Now, as to people who were denied for excessive arrears in this interim 11-month period, there's really no clear rule under FHA. I've seen in some of the materials going out to servicers that FHA is asking them to basically review some of these if it's requested by the borrower. But as a practical matter, if somebody had an excessive arrears denial 10 months ago and all of the financials that they've submitted are 11 months old, I think you'll probably need to reapply. You won't be able to just appeal that and get a retroactive TPT based on an old application. Okay, so let's start with sort of the first step of determining the terms of any FHA HAMP loan modification. First, we need to arrive at the target payment. The new framework of FHA HAMP is to pick a target payment and do a series of steps to try to get as close as possible or under that target payment. And the target payment is calculated through this series of steps. Either 31% of your gross monthly income, 80% of the current mortgage payment, or 25% of your gross income. The steps just are laid out there, so I won't just read this slide to you, but the bottom line is For most people, it's going to be 31%. But for people who already have an affordable mortgage payment that's below 31% of gross monthly income, they're lowering it to generally 80% of the current mortgage payment, unless that would bring you under 25% of your gross monthly income. So the greater of 80%, 25%, and then the lesser of that outcome and 31%. So the first step of the FHA HAMP waterfall is the standalone partial claim. And the goal here is to reach the target payment simply by reinstating an already affordable loan. So if your current rate is at or below your market rate, right now the market rate is, I believe, 4.625, somewhere in there. So it's, we're really talking about low rates, either previously modified payments or somebody who had a very cheap adjustable rate mortgage. The current payment also has to be at or below your target payment, basically meaning that it's affordable under that calculus that was just laid out on the previous slide. And there also has to be sufficient partial claim to cover arrears and the fees. And borrower contribution is likely available here. So basically that means that the arrears and fees can't exceed 31% of your unpaid balance at default unless the borrower has money to cover that difference. If all three of these criteria are met, then a partial claim is issued, basically principal forbearance, and then the loan continues as it was, just you've reinstated it. If these aren't met, and they won't be met for most people, then we move to step 2, which is a standalone loan modification. A standalone loan modification is basically exactly the same as an FHA loan modification. The goal is to reach the target payment by capitalizing arrears and modifying the loan. So arrears are capitalized, the interest rate is set to the market rate, and the loan is re-amortized over 30 years. Unlike FHA loan modification, the traditional loan modification, the goal for the FHA HAMP standalone loan modification is to get below the target payment, not just reduce the principal, reduce the payment. So as long as your previous payment was affordable, you could actually get a standalone FHA HAMP loan modification, even though it wouldn't reduce your payment, the $100 and 10% required by an FHA traditional modification. And all of this is based on by the payment has to cover principal, interest, taxes, insurance, and FHA insurance. So that's the 10% and $100, and that's the target payment. So if that creates a payment that's below your target, that's what you get. You get the standalone loan modification. If not, we have to use the partial claim to defer principal. So we adjust the loan terms in the same way that we did back with the standalone modification or the traditional modification. And then what we're going to do is apply the partial claim as necessary to reduce the payment to the target. So this is always going to get you a payment that is exactly at your target payment. And the idea is by deferring principal, we lower the amount of amortizing mortgage and we bring down the payments. If there's not enough partial claim to lower the principal lower enough to reach your target payment, then we have to go to step 4, which is a modification with increased payments. So modification with increased payments, basically the waterfall gives up on making the target payment. They say, we can only change the terms in this way. We don't have enough partial claim to forbear anymore. But let's just look at the payment that we have and see if it's affordable. So we adjust the loan terms in the way that they're always adjusted for FHA. we use all the partial claim for principal forbearance as much as we can get, and we just look and see if this new payment is at or below 40% of the borrower's gross monthly income. If it is, then that's okay. The borrower gets that payment and those terms. If not, the borrower is just not FHA HAMP eligible. Okay, so now get to the meat of this and go through an example in some detail. So one of my tasks at MFY is that I maintain the FHA Waterfall Worksheet, which performs the calculations that are laid out in Attachment A of Mortgagee Letter 2013-32 as understood through the new FAQ. This worksheet is available at the link provided. You can also get it by just going to mfy.org, going to the Foreclosure Prevention Project website, and then there's a link straight to it. It does require Excel 2007 or better. So if you have Excel 2003, it will not display right, unfortunately. But we're going to run through one example using the worksheet, but I've got a bunch more examples in the written materials, pages 17 through 44. This one, I believe, starts at page 39 if you've printed out your written materials and want to follow along. Okay. Oops. Sorry about that. Okay. So this is the situation for our borrower. This is the first screen, and basically what it asks for is the borrower's budget. Now, unlike HAMP, as it's traditionally known, FHA does not just depend on gross monthly income. It also analyzes net income and surplus income. So we need, we've got sort of the employment information here, monthly employment income, an amount of rental income. Sorry if these numbers aren't displaying very well for you. Like I said, this is all in the written materials, so you can get a better sense of the numbers. This screen in particular is at page 41. So we enter in that income information, and then because we need net income, we also enter in the deductions from the paycheck, since these come out of net income. And then we also list some other expenses which come out of surplus income. And this is that person's budget. The next screen is sort of the other inputs, which are mainly mortgage inputs. So, we enter the type of the loan, which FHA didn't provide some of those, exotic pay option, interest-only type mortgages. Everything that gets FHA insured is either a fixed rate or an adjustable rate, amortizing. So this person has a fixed rate mortgage with an original principal of $200,000. It's a 30-year loan, and their interest rate is 8.5%. They took out this loan, I believe, in summer 2005. Their first payment was August 2005. We have taxes and homeowners insurance listed. One sort of fun thing about this is every FHA mortgage generally at least starts with a mortgage insurance premium, which is the payment to FHA for mortgage insurance. The premiums for this are calculated according to a formula. So of course, it's always better to know what the monthly MIP is. But if it's not known, you can answer a few questions. In this case, whether or not there's two types of MIP. There's an annual MIP, which is paid monthly, and then there's an upfront MIP, which can either be paid out at the closing in cash, or it can be financed into the mortgage. So in this case, the borrower did not finance it. And then the original value of the property, which is either an appraisal or a sales price, And these together, along with the origination date of the mortgage, can do a pretty good job at estimating what the monthly MIP charge is. So here, the monthly MIP charge is a little under $76. So we have principal and interest charge of about $1,540, and principal, interest, taxes, insurance, FHA insurance total of about $2,050. The next step is we need to figure out what the borrower's unpaid principal balance is. Here, the borrower was unable to supply their unpaid principal balance at default. We only had the date on which they defaulted. So we selected the only default, that we only have the default date, and then we put in the default date. And the worksheet just sort of guesses what the unpaid principal balance is based on the amortization schedule of a loan with those terms. So we add in then any fees or costs that have accrued that are going to be added into the mortgage, and then the Freddie Mac primary mortgage market survey for 30-year fixed rate loans as of the day of analysis, which in this case was 4.33. So we add the risk adjustment, which, as I said, is a quarter of an interest, a quarter of a percent of interest. We get the market rate, which is 4.625. Over on this side, there are no inputs here, just some calculations. And so from the previous screen, it takes the gross monthly income, subtracts out the deductions from paycheck, and arrives at the net income. Then it takes the living expenses, adds this to the contract housing cost to get total expenses, and we have the outcome is a borrower here with considerable negative surplus income. So we start out here by looking at whether or not we're going to get a forbearance plan. And here we are not, of course, because the borrower has negative surplus income. So they're going to not be eligible for any of the forbearance plans. They're going to not be eligible for the FHA traditional loan modification, which is in this little box. So the next thing is to go to FHA HAMP, and we're going to try to figure out their target payment. So we take the values for 31% of gross monthly income, 80% of the current payment, 25% of gross monthly income, and we take the greater of 2 and 3. So we take 80% of current PIDIA, and then we take the lesser of 1 and 4. So we're going to take the lesser of 31% and 80%, so we're taking 31% in this case. So the next thing we have to do is to calculate the maximum partial claim. So the maximum partial claim is 30% of the unpaid principal balance at default. The worksheet had estimated that the unpaid balance at default was about $180-something thousand. 30% of that comes out to about $54,000. Then we go to step 1 of the FHA HAMP waterfall. We look at the interest rate, and we ask ourselves, is it above or below, or at or below the market? Here, the interest rate was pretty high. Let's see, it was 8.5%. That's well above the market rate, which is 4.625%. So we know that this borrower is not going to be eligible for a standalone partial claim. Also, their current PIDIA payment is not at or below their target payment. They would not want to be kept at their current payment. So we look at whether or not they're eligible for a standalone FHA HAMP modification. So the target payment is about $1,357. And if you took this borrower's capitalized unpaid principal balance and amortized it at the market rate over 30 years, and then added taxes, insurance, FHA insurance, you'd get a payment of $1,660 and a little bit more. So obviously, the modification payment is not at or below the target, so we're going to move on to the next step, the modification with a partial claim. So here, as I said before, we're trying to apply the partial claim to create principal deferment, bring down the payment. The target payment requires about $59,000 of principal deferment in order to make the math line up, but we only have here about $54,000 of principal deferment available. So again, we didn't quite reach that. We're not there. We have to deal with a payment above our target. So now the question here is we re-amortize and capitalize, we adjust the interest rate to the market rate, and we add the entire partial claim that we have to the mortgage to try to bring the payment as low as we possibly can within the FHA framework. And then we have to figure out where we are with regard to the borrower's income. So here, you'll notice on this step, there's only about $5,600 difference between this. There's not a lot of difference here. So the payment that we need to support this amount of principal is not that far above our target, $1,380 versus $1,357. And this only creates a debt-to-income ratio of 31.55%, which is great. It's well under 40%. It's affordable. The borrower is eligible for an FHA HAMP modification. So then the last tab of the worksheet provides sort of what the final outcome is. So here, the borrower is getting an FHA HAMP modification with a partial claim. Their monthly principal, interest, taxes, insurance is $1,380.77, of which $747.27 goes to principal and interest. All the rest is being taxes, insurance, FHA insurance. There's going to be an interest-bearing principal, the amount still being paid to the mortgage company, of $145,000 and a little bit more. And then there's a partial claim, which, as I said, is a second mortgage that's interest-free that's payable to HUD, and that is about $54,500. The interest rate on the interest-bearing principal is the market rate of 4.625%, and the remaining term is 360 months, 30 years. So again, this worksheet, it's available at the link provided in the PowerPoint as well as in the user's guide. And if you have any questions about it, you can always just click that link and send me an email. Let's see. Oh, and another thing is that if the borrower has insufficient income to support an FHA modification, this screen will tell you how much income they need, what the minimum income is, so that you know whether the borrower you're talking to is, $100 of gross monthly income away from being able to be modification eligible, or whether they're $2,000 of monthly income away from being FHA eligible. So that's, of course, very useful. Okay, so now I'm going to sort of, in summary, compare the FHA options that are covered in the worksheet. So first of all, there's the traditional FHA loan modification, which has a 30-year term, an interest rate of the market interest rate, which again is the Freddie Mac primary mortgage market survey plus 0.25%. All the arrears in the mortgage, all the missed payments, fees, costs, all that good stuff is paid by capitalizing them into the balance. And where is your new payment relative to your target payment, well, it doesn't apply. Basically, an FHA loan modification is underwritten without regard to the target payment because anybody eligible for an FHA loan modification already has surplus income, meaning that their mortgage is more or less affordable to them. So all that the FHA loan modification is doing is looking to decrease the payment by a bit, 10% and $100. The FHA standalone partial claim, the term of that is just the remaining term on the loan. The loan itself remains unmodified. The rate is the contract rate, so just whatever is provided for in the contract. So if you had an adjustable rate before, the borrower will still have an adjustable rate. If they had a fixed rate before, it'll still be a fixed rate. Doesn't change the rate at all. The arrears in a standalone partial claim are covered by the partial claim. Basically, the partial claim reinstates the loan. And this will always produce a payment at or below the target payment. Of course, barring a pretty crazy coincidence, it's going to be below the target payment. Okay, the next step, the standalone modification. Again, this modifies the terms in the same way that the FHA loan modification does. So 30 years, market rate, arrears paid by capitalization. But here, the payment's always going to be at or below the target payment, and again, generally below, except for a free coincidence. Then next step is FHA modification with the partial claim. Here, the term is again 30 years, the rate is again the market rate. The arrears are paid by a combination of capitalization and the partial claim, and this should bring the payment to exactly the target payment. Shouldn't be above, shouldn't be below, should be right there because they're only applying enough partial claim to exactly get you to the target. And then there's FHA HAMP with an increased payment, 30 years, market rate, arrears paid through a combination of partial claim and capitalization, and then the target payment is always going to be above the payment is always going to be above the target payment because we've modified the mortgage to the extent that FHA rules will allow, and we're just looking for affordability, not necessarily target affordability. Okay. Okay, great. So I was happily able to get through that pretty quickly. So I'll gladly take some questions. See, I got, I think, a questions listed out here. Okay. Yeah, actually, could you read them out to me? I'm having some issue actually seeing the full question on my screen.
Sure. You can pull it, just so you know, you can pull it if you do the arrow thing and kind of adjust the size.
Okay, there it goes.
You see?
Yeah. Okay.
All right. And actually, the very first, I believe, is actually they found the answer later on, but you can feel free to answer if you want.
Yeah. Okay. So let's see. Okay. So. Okay. Well, I see some questions about receiving a copy of the PowerPoint, but
yeah,
I'll leave that. I'll leave that to the good people at Empire Justice. So, what banks are subject to FHA, and how do you determine this? That's a great question. So basically, FHA rules follow FHA mortgages. Any servicer that does that services an FHA mortgage has to abide by these rules. And you know whether or not a mortgage is an FHA mortgage by looking at the actual mortgage itself. The security instrument will have something in the top right corner that has an FHA case number. And as long as that's an active case number, then the mortgage is subject to the FHA rules. Overall, about 10% of mortgages are FHA mortgages, but FHA mortgages are also supposed to encourage home ownership. So they are usually directed more towards low to middle income people, and so if you do like legal services, they're usually more than 10% of our client base, although they are less than 10% of the overall mortgage population. Okay, so the next question is, with special forbearance, can payments be suspended for 12 months if the borrower is unemployed for 12 months? Let's see. So basically, special forbearance, just lost that page, sorry, one second. So special forbearance has to always allow for 12 months of forbearance, but it's not usually complete forbearance. The borrower has to be unemployed the whole time. So I would say that the answer to this question is yes. If the borrower is unemployed for a year, then they will be on special forbearance for a year. The limit on the amount of time for special forbearance is how far behind on the mortgage the borrower can get. So like I said, they'll be receiving a partial payment. During this period, the borrower will enter the special forbearance no less than 3 months behind. So how long they're able to stay with the special forbearance depends on how long they're unemployed and what portion of the mortgage payment they're able to make. Okay. Okay, so the next question, what is the mortgagee letter number that addresses attorney's fees? I do not know that off the top of my head, unfortunately. I would direct you to the written materials. Let's see, I believe that that would be in page 5 or 6, somewhere in that section. But it is cited in a footnote.
And again, everybody should have received a copy of those materials earlier today. If they did not, you can email Michelle or me, and we can make sure we get them to you. But just be aware that frequently these emails seem to get put into the junk or spam boxes, so just double check those boxes first before you contact us.
Okay, great. Let's see. So regarding the target payment, is this based, so 80% of the current payment, is that based on principal and interest or everything, principal, interest, taxes, insurance, and FHA insurance and any association fees? And it's the latter. It's the full housing cost, not just the principal and interest. Let's see. I see some questions here about the priority of loss mitigation options. I'm hoping that got addressed later on when we went through everything. But if it's not, just send it again so that it's at the bottom of my questions when I get to the bottom. Let's see. Okay. Are the changes? Okay. Yeah. So, question about changes to the waterfall from the February 12, 2014 FAQ. Yes, so all of the changes to the waterfall that were discussed since Mortgagee Letter 2013-32 are from that FAQ. And these are all built into the worksheet calculator that's on the website and built into the user's guide that went out with this with these materials. Okay. Okay. Let's see. Another question here about asking for some clarification about this $300 surplus. So the $300 surplus income rule is, it's a requirement for an FHA traditional modification. And why I was saying that you should never show surplus unless you want a repayment plan is that if your borrower is ineligible for an FHA traditional modification because they don't have the surplus income, they'll probably get something better on FHA HAMP because the worst they can do is the FHA HAMP standalone modification, which has the same terms. And if that doesn't create a payment below their target, they can get principal deferment from the partial claim. Really go through and try to list all the expenses your borrower has. Your borrower likely does not have, after paying all of their bills and paying their pre-modification mortgage payment, they likely are not able to save $300 and 15% of their net income every month. So you should not, if possible, be submitting RMAs that reflect your borrower taking home surplus money that they don't have. Okay. Question about how all this information should be raised in mandatory settlement conferences. And basically, I think that, if you're in settlement conferences and your goal is some sort of modification, whether or not the other party is acting in good faith is going to be determined based on whether or not they're following the proper rules. And in this case, if it's an FHA mortgage, the proper rules are the FHA loss mitigation rules. So everything that you're going towards should be making sure that they are analyzing your borrower under these rules and applying these rules correctly. Okay. A question, can you apply for other loss mitigation during a special forbearance, or do you have to wait until the end of the 12-month period, i.e. if you get a job in month 3, can you apply right away? And the answer to this question is yes, yes, yes. Basically, your special forbearance period will end when the borrower gets employed. Just the plan for it needs to be at least 12 months. So 12 months or employment. So if your borrower is employed in month 3, then yes, the special forbearance plan will end. You'll have to apply. Okay. Okay, so can you briefly go over the disputed information regarding the $300 or 15% surplus? So basically, this is sort of getting into the weeds a bit, but mortgagee letter 2013-32 in describing the eligibility criteria for FHA HAMP it states that one of the requirements is that to be eligible for FHA HAMP, a borrower must not have surplus income above $300 and 15%. But if you actually look in Attachment A, which is the boxy waterfall thing, it states, that if somebody doesn't get that payment reduction in the loan modification, then the servicer should look at FHA HAMP. So it's a clear contradiction in terms within one mortgagee letter. And in practice, I've seen borrowers showing surplus income above these limits get analyzed for an FHA loan modification, not meet the payment reduction requirement, but get an FHA HAMP reduction. So I don't think anybody's really applying that rule in the way that it's in the text. I think everybody's looking at Attachment A and basing their analysis off of that, including the National Servicing Center. Okay. What proof should be requested with respect to compliance with the waterfall? I mean, I think how I recommend that people use the waterfall is, to get all of your inputs as correct as possible and use that to set your expectations and your client's expectations. And then from that, look at what offers you're getting from the servicer. So there's no MPV test. There's no secret other step that you're not privy to. If they pass the waterfall, they get the modification. So if your servicer is not addressing, if they're giving you an offer that clearly doesn't comply with the waterfall, then they're not negotiating in good faith. They're not sort of playing by FHA's rules, and they're not doing it right. So I think you would then use that in your argument in a good faith motion or whatever other tact you take in appealing wrongful denials, either appealing it with the servicer, making a complaint to the AG if it's a servicer that falls under the aegis of those national servicing settlements, and so forth. Let's see. Another question, have I ever dealt with the National Servicing Center for help with denials that it appears are incorrect? I actually have not. This also notes that they've seen many denials with the reason expenses exceed income, which would tend to show that the loan was not run through the complete waterfall. So I have not had much experience, or not any helpful experience really appealing things through the National Servicing Center. I think as a practical matter, the National Servicing Center sees itself as existing to help servicers be in compliance with FHA rules more than it sees itself as being there to help borrowers make servicers being in compliance with FHA rules. And I would, like I said, I don't think it's a dead end to escalate there, but I think there are hopefully other better ways to try to enforce compliance. And of course, expenses exceed income is not a reason for denial for FHA HAMP. So that definitely would indicate that the servicer is not complying with FHA rules. Okay, so I think I got through all the questions, and it looks like we are just past 1. So my phone number and email address are on the last slide. You can feel free to get in touch with me if something else comes up. I'm happy to talk about this stuff. And otherwise, I just want to thank everybody at Empire Justice for setting this up, and thank you all for attending.
This was very good. Thank you very much. There was one more comment from Amanda in Syracuse. She said escalating to the NSC can be very effective.
Can be effective.
Yes, well, that's good to know. They can threaten not to pay out. That gets results most times. Good to know. Okay, we do have, Michelle has a couple of announcements, and then I just wanted to make an announcement about our next webinar. We are trying to do these now on a monthly basis. Last year they were bi-monthly, or twice a month, and this year we are doing one a month. So the next one scheduled is Sarah Minaj. She has agreed to do a webinar on April 9th. She's with the South Brooklyn Legal Services in New York, and the title is Tools and Techniques for Researching Homeownership of Notes and Mortgages, and I'll just read to you the very thorough description that she provided. The vast majority of mortgages are not maintained and serviced by their originating lenders, but are sold as collateral for securities. One result of the securitization of mortgage loans is that when securitized loans default, it is often difficult to determine which financial institution owns the loan and has the right to enforce the mortgage. Securitization can also create confusion and uncertainty about which entity is authorized to enter into modification agreements with borrowers with delinquent loans and what rules may govern how or whether that loan may be modified. This training addresses the various circumstances in which ownership of a loan can matter, explains the methods for investigating the ownership of the mortgage note, and explores what can happen in litigation and in negotiation contexts when ownership questions arise. So very specifically, I had asked her to just walk us through how do you find these pooling and servicing agreements and how do you use them. So I am looking forward to it, and please stay tuned for the invitation coming shortly. So, Michelle?
Yes, and one last thing, the CLE code for today, I did put that into the chat box a while back, about 15, 20 minutes ago, but the code for today is E as in Edward, 6520. Again, that's E as in Edward, 6520. So make sure you mark that down on your information form and get that to me, and we'll mail out the CLE certificate to you. And the announcement for our April webinar, you should be seeing that in your inboxes somewhere around the end of this week, I'm hoping.
Yeah, if you don't get the invites directly, Michelle, they come from you? I'm trying to think how they come.
Yes, they come with my name on the header.
That's what I mean, right. So when you get your invites, those of you who are in New York City, the method of communicating with you is a little bit piecemeal. So if they get forwarded, Jay-In will forward some, Karina will forward some from Center for New York City Neighborhoods. So depending upon where you get them from, you might want to just check in if you don't see it in the next week or so. Michelle, when are you going to send it out, do you think?
Most likely no later than Monday.
Oh, okay, great. So if you don't see it by next week, then give us a call or check in with the person that you received the last one from. I apologize to those of you in New York, just because of our role as the anchor. We have access to some, and we don't have access to everybody, so we piece it together that way. Anyway. All right, well, thank you. Joseph, thank you. You are phenomenal, as always. I appreciate your ability to put this together and make it fairly straightforward and as simple as one can to understand. And the calculator is always fantastic and truly helpful. And thank you. We look forward to chatting next month.
Thanks a lot.